The credit economy. The house is collateral, the product is the loan. In the modern credit economy, a house is not primarily an asset being bought. It is collateral for the real product being sold, the loan itself. What is actually transacted is duration transformation, the conversion of a household's uncertain future income stream into immediate purchasing power through long-term debt. Section 1. The core mechanism. When a buyer approaches a bank for a mortgage, the bank does not lend out pre-existing savings. It creates the loan amount, for example $500,000, as new money with a few keystrokes. On one side of the balance sheet appears a new asset, the bank's right to collect principal and interest over 15 to 30 years. On the other side appears a new deposit that the buyer uses to purchase the house. The buyer gains present control over a large asset. The bank gains a predictable, long-duration income stream backed by the house as collateral. The house itself is secondary. It serves mainly as security in case the borrower defaults. The true economic event is the creation and sale of credit, which transforms future labor and income into today's spending. This is not limited to housing. The same logic applies to cars, education, business expansion, infrastructure projects, and even government spending. In each case, the underlying good or service is collateralized so that credit can be extended and new money created. The modern economy runs less on the production and exchange of real goods and more on the continuous origination, pricing, and trading of debt claims on future income. Section 2. Duration transformation explained. Duration transformation lies at the heart of the system. Households and businesses have short to medium-term income flows but desire long-term assets. Banks and the broader financial system bridge this gap by issuing long-term loans funded by what are effectively short-term liabilities, such as deposits that can be withdrawn quickly or funding sourced in money markets. The bank profits from the spread between the interest it charges on the long-term loan and its own cost of funds. By extending credit over decades, it pulls distant future cash flows into the present, inflating current asset prices and economic activity. When credit is cheap and abundant, asset values rise sharply. When the price of credit increases through higher interest rates or tighter lending standards, the cost of carrying that duration rises, and entire markets reprice downward, even if the physical supply of houses or cars remains unchanged. This is precisely what the widely shared 2021 versus 2025 mortgage comparison image reveals. The house price stayed at $500,000. Yet the monthly payment jumped from roughly $1,686 at 3% to $2,528 at 6.5%. The sticker price of the house did not change. The price of money did. Because most major purchases are leveraged through credit, shifts in the cost or availability of credit ripple through the entire economy faster and more powerfully than changes in wages or productivity. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Real-world stakes. The dominance of credit as the primary product creates several structural consequences. Asset price sensitivity. Home prices, stock valuations, and business investment become highly leveraged to interest rate cycles rather than fundamentals alone. Debt dependence. Economic growth increasingly relies on ever larger volumes of new credit creation. Slowing credit growth can quickly translate into slowing demand across housing, autos, education, and infrastructure. Intergenerational effects. Younger households must commit larger portions of their future earnings to service debt simply to access the same assets previous generations acquired more cheaply in lower rate environments. Systemic risk. Because so much money and collateral value are tied to long-duration debt contracts, sudden changes in credit conditions, such as rate hikes, tightening standards, or loss of confidence, can trigger widespread repricing, reduced liquidity, and economic contraction. Section 4. Contextual clarity. This system is not accidental. It emerges from the architecture of fractional reserve banking, central bank policy, and government-backed deposit insurance and lender of last resort facilities. The state grants banks the charter to create money through lending. then backstops the system to maintain stability. In return, the financial sector earns a structural claim on future economic output via interest payments. Critics have noted this dynamic for generations. Henry Ford is often quoted as saying that if people truly understood the banking and monetary system, there would be a revolution by morning. John Kenneth Galbraith observed that the process by which banks create money is so simple that the mind is repelled. These insights point to the same truth. In the credit economy, the house, the car, or the degree is collateral. The loan and the duration it commands is the product. Understanding this reframing shifts the debate from why are houses so expensive to a more precise question: why has the price of credit become the dominant variable shaping affordability and economic activity? When credit is the product, changes in its price do not merely affect one market. They reprice the entire economy downstream of debt.